Okay, let's dive in. We've got this really fascinating stack of sources here today. And it's not just, a single story. It maps out how extreme wealth gets built over centuries, really, from those 19th century industrialists, the steel barons and oil men, all the way to, well, today's tech founders and financial players.
It's quite a collection, and what's powerful about looking at it this way over such a long time frame is that you can sort of filter out the noise of the specific industry, whether it's steel or software, and really focus on the underlying mechanics. That's our mission here, isn't it?
Exactly.
To trace those common threads, the strategies, the maybe ethical flexibility we see sometimes, the way they harness economic forces, things that allow these, well, truly massive fortunes to be built, and crucially, how that shapes everything else, the broader economy. Are we converging or diverging?
Yeah, we're not just making a list of rich people. We're asking how. How did they build these systems almost designed for this kind of outsized growth, and how have those systems changed or maybe stayed the same? So we'll start way back with the sort of foundational stuff, the brutality maybe of people like Carnegie, then jump into the 80s, all that financial engineering, the debt.
The LBO era.
Then into Silicon Valley, the big dreams, the huge optimism, but also sometimes the crashes and deceptions.
Right. Theranos, FTX, that sort of thing.
And we'll try to tie it all together at the end with the economic framework that the sources lay out. Does this whole process naturally lead somewhere stable? Or is it inherently tilted towards more and more inequality?
That's the big question.
Right. So if we really want to understand how wealth works today, you kind of have to go back to the beginning, or at least the beginning of this industrial scale wealth, late 19th century.
The Gilded Age.
Exactly. And this old wealth, it seems like it was built by men who wanted, maybe needed, absolute control. Control over everything in their production process, right down to the factory floor.
That's spot on. Our sources really point to Andrew Carnegie as maybe the archetype here. Achieving that kind of dominance in manufacturing, it required this singular strategic ruthlessness. His whole fortune was built on getting and keeping total control, especially over labor costs.
And the key moment wasn't some new invention, was it? It was a conflict.
No, exactly. It wasn't just about a better way to make steel, though that helped. The pivotal event, the one that really cemented his power, was the violent defeat of the Amalgamated Union at his Homestead plant, 1892.
That Homestead strike, it feels absolutely central. And Carnegie knew it wasn't just about that one plant, did he?
Oh, absolutely. The sources are clear. He saw this as completely essential for the long-term strategy of his whole empire. He believed, and probably correctly, that if the Union won at Homestead, if they'd been allowed to survive there,
They'd have momentum.
exactly, they'd be emboldened. It would give them the leverage they needed to organize his other big plants, like Duquesne, Edgar Thomson. He couldn't have that.
He was thinking several moves ahead. For him, breaking that union wasn't just about costs. It was about enabling what he called, I think the source says, a glorious new era.
Yeah, an era where management had total freedom, no restrictive contracts, freedom to cut costs, push productivity, bring in new machines, whatever they wanted, whenever they wanted. It really shows you the mindset, doesn't it?
It does.
The willingness to command that kind of confrontation, even violence, maybe from a distance, but still command it.
And the sources even capture that awkwardness, maybe.
Ah.
There's a quote where Carnegie admits feeling anxious about having to be, brave at a distance.
That's the phrase, brave at a distance.
It suggests he knew, on some level, the human cost, right? Even while he was rationalizing it as necessary for business, giving up union power was basically the price of entry for his scale of wealth.
And once you have that kind of control over production, over labor, then you unlock the next level, scale. Integration. That's the second big mechanic of this old wealth. Think Rockefeller, think Vanderbilt. It wasn't just owning a factory, it was owning the whole chain.
Right, an empire.
An empire that needed constant, massive amounts of money just to operate.
The numbers are just wild when you look back. Standard Oil. When the trust was eventually broken up, the court case revealed its value something like $660 million.
Which is staggering for the time.
And it wasn't just refining oil. They were pumping out 35,000 barrels a day, every day. And they owned, over 100,000 miles of their own pipelines.
That kind of integration, that scale, it required financial muscle that, frankly, usually only governments had back then. And Vanderbilt, with the railroads, he operated with a similar kind of private power.
There's that amazing detail in the sources about him just loaning out huge sums. Loaning Robert Schuyler, another railroad guy, $600,000
Right.
in October of one year.
Just like that. Because Schuyler's ship, the Independence, had sunk and he needed cash fast. Vanderbilt takes thousands of railroad shares as collateral.
$600,000. You
Yeah.
have to stop and think what that meant then. The sources mention the mercantile agency, the credit rating agency of the day. They'd classify someone as super wealthy if their entire estate was worth $600,000.
And Vanderbilt's making a loan of that size. A personal loan, basically.
It shows how these individuals could act almost like central banks,
Yeah.
right? Using their private fortunes to rescue or influence or maybe even wage war, totally outside the public system.
And having that kind of capital, that ability to deploy it, leads right to the third piece. Surviving the downturns, the financial storms, crises like the Panic of 1893. They weren't just risks for these guys, they were opportunities.
How so?
Well, they act like stress tests, right? They wipe out the weaker players, the ones without the deep pockets or the nerve, and that just clears the field for the strongest ones, like Carnegie, to consolidate, to expand their empires even further.
We see Carnegie really feeling the pressure, though. During that 1893 crisis, late October, he writes to a partner, saying he'd never suffered so much in my life and was still very weak from the strain.
Yeah, it wasn't abstract for him. It was personal, intense. This was a fight against total collapse.
But then, just a few weeks later, by November, he's writing again, saying he thinks they've weathered the immediate storm, though he's still hoping his banks can squeeze through.
That phrase, squeeze through, tells you how close to the edge they were operating.
Absolutely.
But the pattern holds. The sources, the historical record, it all shows that these crises, scary as they are, end up concentrating wealth. The survivors pick up the pieces, buy assets cheap, gain market share. It's a brutal but effective consolidation mechanism.
Okay, so if the old wealth was about controlling steel mills and pipelines, the physical stuff, Section 2 in our sources shows this huge shift, right, towards controlling the money itself, the ledger sheet.
Exactly. This brings us to the 80s, the era of the leveraged buyout, the LBO. Debt becomes king.
It's a fundamental change. We move from making things to, well, making deals, extracting value through finance, not just production.
And the LBO boom wasn't just some random market frenzy. It was actually fueled, maybe even subsidized by the rules of the game, specifically the U.S. tax code. That's a key institutional mechanic here.
Explain that. Why was debt suddenly so attractive? How did the tax code encourage it?
It's pretty simple, actually, but incredibly powerful. The tax code allowed companies to deduct the interest they paid on debt from their taxable income. So borrowing money lowered your tax bill.
Yeah.
But dividends, the money paid out to shareholders, the owners, those were not deductible.
Yeah.
So the system itself created this huge incentive to finance things with debt rather than equity. It basically subsidized borrowing on a massive scale.
Right. So the government was effectively encouraging companies to take on huge amounts of debt for these buyouts.
Precisely. And then you needed the fuel to make these deals happen fast. That's where Michael Milken comes in.
Ah, the junk bonds.
The junk bonds. Before Milken, if you wanted to do an LBO, you had to get maybe 30% of the financing from traditional, cautious sources. Insurance companies, mostly. Slow money.
But Milken figured out how to raise enormous sums incredibly quickly using these high-yield, high-risk junk bonds.
Completely changed the game. He bypassed the old gatekeepers. Suddenly, you could finance hostile takeovers, massive deals, almost overnight. It provided the high-octane fuel, as one source puts it, for deals like the epic battle for RJR Nabisco.
Oh yeah, RJR Nabisco. That became like the poster child for 80s excess, didn't it?
Yeah.
That bidding war was insane.
It really was. You had the CEO, Ross Johnson, leading a management bid, which then got blown out of the water by the bid from KKR, Henry Kravis's firm.
And Johnson became this national symbol of greed.
He did. But what's fascinating, reading the inside accounts, is the reaction of the RJR Nabisco board. Despite the mind-boggling numbers and complexity, the sources say they were secretly kind of relieved when the Kravis bid came in so much higher.
Relieved.
Because it made their decision easy. They didn't have to choose the management bid, which many of them apparently found ethically troubling even by the standards of the time. The sheer size of the KKR offer gave them cover to just take the money. The mechanics of the deal sort of forced the ethical question off the table.
No. So that kind of financial maneuvering, it didn't stop in the 80s. It just evolved, maybe got more hidden. Which brings us to the next phase. Outright manipulation within the financial system itself.
Yeah.
The LIBOR scandal.
Right. LIBOR, the London Interbank Offered Rate. This was meant to be a crucial benchmark, right? an average rate showing what banks were charging each other to borrow, used in trillions of dollars of financial contracts worldwide.
Supposedly an objective measure.
Supposedly. But the sources detail how traders across different banks were systematically manipulating their LIBOR submissions, pushing the rate up or down by tiny amounts to benefit their own trading positions.
And this wasn't just one bad apple.
No, it was described as happening across corporate lines for their own financial gain. It looks an awful lot like collusion. A conspiracy, really, operating inside the system.
And the communications between the traders? It's kind of shocking how blatant it seems reading it now. Or maybe how nervous they were about getting caught.
There's that specific instance with Tom Hayes, a key trader. He tells a colleague who is submitting the rates for their bank, basically, push the rate lower for me, but then adds, make sure not to put it in writing.
Wow. He knew it was wrong.
Seems like it. And yet, the culture allowed it. Colleagues apparently found Hayes unimpressive, even ultra-arrogant, but he operated successfully within a system where this kind of thing was, if not explicitly condoned, at least tacitly accepted or subtle enough to fly under the radar for a long time.
The complexity sort of became a shield.
It did. Another source mentions Hayes talking openly about getting info from other traders, and when someone asked if he'd do the same at his next job, a colleague just said, absolutely. The manipulation was almost institutionalized.
Okay, so you extract wealth through leverage, maybe through manipulating benchmarks. The next logical step, if you want to protect that wealth and keep the system favorable, is influence, right? Political influence.
Absolutely necessary. And this brings us to the really organized efforts, like those detailed involving Charles Koch. The sources describe their strategic shift after Obama's election in 2008. Koch apparently saw it in almost existential terms, fearing this wave of regulation and government spending.
And their response wasn't just more lobbying.
No, they decided lobbying was inefficient. Dealing directly with politicians was like dealing with actors. They saw politicians as just actors playing out a script.
So what was the alternative?
Change the script itself. Their goal became to supply the themes and words for the scripts.
Yeah.
By funding a whole ecosystem, universities, think tanks, advocacy groups, to develop and promote the ideas they favored, particularly radical free market ideas.
Trying to shift the whole intellectual climate.
Precisely. And they backed it up with serious money. The sources mention the Koch network contributing well over $100 million, a lot of it undisclosed, dark money, specifically to push these ideas into the mainstream, to change the terms of the debate.
And then came a legal game changer.
Citizens United, the Supreme Court decision in January 2010. That ruling basically opened the floodgates for corporate and billionaire money in politics, framing it as free speech. For these wealthy activists, or investors as the source calls them, it was seen as a huge victory, a promising dress rehearsal for even more outside spending to shape elections and policy. It essentially legalized using massive wealth as a primary tool of political influence.
All right, let's shift gears again. We move into the tech world, Silicon Valley. Here, the story feels different, doesn't it? Less about maybe brute force or financial leverage and more about vision, speed, and sometimes things going spectacularly wrong.
Yeah, the emphasis changes. The early tech giants, they established a different kind of control. It was about the user experience, the product's culture, the narrative. Steve Jobs is maybe the ultimate example of this mixed visionary focus, but also this intense obsession with aesthetics and control.
There's that anecdote about his employee badge at Apple.
Yeah, demanding badge number 0, refusing number 2. It sounds petty, maybe.
A bit.
But it speaks volumes about his need to be seen as the primary creator, the originator. And that obsession went way beyond his own status. It flowed directly into the product. He cared deeply about the tactile experience, even just opening the box.
The unboxing ritual.
Exactly. He believed that moment set the tone. It told you this in the iPhone. The iPad was special, meticulously crafted. It was about controlling perception from the very first touch.
Jeff Bezos at Amazon seems to share some of that intensity, that focus, but maybe applied differently, more about category definition.
Right. Bezos was adamant from early on. Amazon wasn't just a retailer, it was a technology company. That framing was crucial, and his core philosophy seemed to be that invention was the only way out of tough spots. You don't just compete, you invent your way forward.
And that led to some really aggressive moves, like the push into ebooks. setting the price at $9.99.
That $9.99 price point, it was a gut call, the sources say, deliberately mirroring Apple's 99-cent price for songs.
Even though it meant losing money on every sale initially?
Yeah, most publishers were selling wholesale ebooks for around $15 back then, so Amazon was taking a loss on every single one. But Bezos saw it as a strategic investment.
How so?
He believed that if he set the consumer expectation at $9.99, eventually the publishers would have to lower their wholesale prices. Market pressure, driven by the lower cost of digital distribution, would force their hand. It was about reshaping the entire industry's economics in Amazon's favor long term.
That kind of culture, though, the move fast, the big vision, maybe prioritizing the story over the immediate reality, it seems like it creates the perfect breeding ground for the downside, too, for boundless optimism to mask really deep problems.
Absolutely. And that leads us straight into the Theranos story, Elizabeth Holmes. She embodied that boundless optimism, didn't she? The sources talk about her using the term extraordinary, constantly, even hyphenating it for emphasis.
Selling the dream.
Selling the dream, exactly. And for a long time, investors, the media, they bought it. They saw it as the kind of passionate belief you need from a founder trying to change the world.
But behind the optimism was, well, it was dangerous deception. The sources have these chilling clinical examples.
They do, like Dr. Sundine's test results. Theranos gives her a cortisol reading below 1 microgram per deciliter. That's a level indicating Addison's disease, a potentially fatal condition.
Okay.
But a simultaneous test run by a standard, reliable lab, LabCorp, showed her cortisol at a perfectly normal 18.8 micrograms per deciliter.
That's not just inaccurate.
It's potentially lethal mismanagement of health information, a completely fabricated result that could lead to disastrous medical decisions. And the core technology just wasn't there. Theranos' last big scientific paper, published way later in 2018.
Yeah.
The blood samples they used were drawn the old-fashioned way with a needle in the arm. They completely gave up on the original promise, the finger prick revolution. It just didn't work.
We see a different kind of rapid collapse focused on finance with Sam Bankman-Fried, FTX, and Alameda Research. The speed of that implosion was breathtaking.
It really was. Alameda's capital just cratered from $170 million down to $40 million, incredibly fast.
So when investors saw this huge drop, what did they think?
Well, according to the sources, they faced this dilemma. Was SBF a fraud or just maybe brilliant but reckless? Were his employees just not up to running a high-speed hedge fund?
So how do they react? Pull all their money out?
Not entirely. Fascinatingly, they reacted probabilistically. They hedged. Most of them kept some money in. They were essentially betting on the chance he could turn it around, recover somehow.
Wow.
That reaction allowed him to keep operating, to still trade, even after that catastrophic loss. It speaks to the culture, doesn't it? In tech and crypto, sometimes even a massive failure isn't the end. It's just a setback, maybe waiting for the next big narrative pivot.
Okay, we've looked at the individuals, the companies, the tactics, from Carnegie's factory floor control to SBF's crypto chaos. But we need the bigger picture now. The economic framework that explains how this kind of extreme wealth concentration happens and, maybe more importantly, why it persists.
This is where the work highlighted from Thomas Piketty in our sources becomes so crucial. It gives us these fundamental dynamics. He talks about two main sets of forces acting on inequality.
Right, convergence and divergence.
Exactly. First, you have forces pushing towards convergence, meaning things getting more equal over time. The main driver here is the spread of knowledge, skills, education, investment in training.
You can see that internationally, right? Countries like China catching up by adopting technologies and skills from more developed economies.
Precisely. Knowledge, fundamentally, wants to spread. It's hard to keep it contained. And as it spreads, it tends to reduce the gaps, at least between nations.
But then there are the forces pushing the other way.
Yeah.
Towards divergence, more inequality.
And this is Piketty's really stark central point and maybe the core takeaway from this whole deep dive. He argues there's no natural, spontaneous process within market capitalism that guarantees these divergence forces won't win out. There's nothing automatic stopping inequality from growing indefinitely, potentially destabilizing the whole system.
So divergence might be the default setting unless something actively counteracts it.
That's the implication. And it comes down to a key relationship mathematically. The relationship between R, the rate of return on capital, and beta, the capital to income ratio.
Okay, let's break that down because it sounds technical, but is really the engine driving this.
Yeah.
R is how fast wealth grows.
Basically, yes. R is the annual return you get from owning capital, things like stocks, bonds, real estate businesses. Profit, interest, rent, dividends, capital gains, all that stuff, expressed as a percentage of the total capital value.
And beta.
Beta is simply the total stock of wealth, or capital, in a society, divided by the total national income generated in a year. So if a country has, say, 6 years' worth of national income saved up as total wealth, its beta is 600%.
Got it. So the key question is how R and beta interact.
Exactly. Specifically, what happens to R, the rate of return, when beta, the amount of capital piled up, increases? Does the return automatically fall proportionally?
And if it doesn't fall much, if you can accumulate more and more capital and still get a really high rate of return on it.
And capital's share of the total economic pie national income inevitably grows larger. If R consistently stays high even as beta increases, wealth concentrates.
Put that in simple terms. What does it feel like if you're just earning a wage?
It means if the money earned from already having money from wealth grows faster than the economy as a whole grows, or faster than wages grow, and if that advantage doesn't really shrink as wealth piles up, then the people who own the wealth pull further and further ahead of everyone who relies mostly on income from labor. It's a built-in bias towards concentration at the top.
So if there's no natural break on this divergence, what has historically stopped it or reversed it?
Shocks. Massive external shocks. The sources point to the 20th century, particularly the period from 1914 to 1945. 2 world wars, the Great Depression, these colossal events absolutely hammered capital values and destroyed wealth across Europe. That caused a huge sudden collapse in the capital-to-income ratio, beta.
And we see this vividly in the example of the Parisian rentiers, right? The wealthy elite living off their investments before World War I.
It's a perfect case study. Before the wars, the richest 1% in Paris had fortunes generating income that was, 80 to 100 times the average worker's wage?
Enough to live incredibly well and pass on that same wealth-generating power to their kids.
Right. They could live lavishly just off the returns, the R, without touching the principal. But after the shocks war, inflation, destruction, high taxes to pay for it, all their capital base eroded. The sources note, kind of poignantly, that they tried to keep living more or less as they always had.
Which meant?
They started eating into their capital, spending the principal because the returns weren't enough anymore to support the old lifestyle.
And the consequence?
By the late 1930s, their fortunes could only generate income maybe 20 times the average wage. Still wealthy, sure, but the ability to sustain that specific, effortless, inherited lifestyle across generations, it had collapsed. That social structure, built on passive capital income, was broken by external forces.
So fast forward to today, without a shock on that scale.
We see the divergence dynamic reasserting itself. The sources highlight how persistent wealth inequality is, even in places we think of as very equal, like Scandinavia in the 70s or 80s. The concentration of wealth was still way higher than the inequality of wages in highly unequal places like the U.S. today. Wealth is always much more concentrated than income.
And look at CEO pay. That gap is astonishing.
It really is. Early 70s, the average big company CEO made less than 30 times the average worker. By the mid-2000s, it was 110 times. That internal corporate structure, combined with capital generally growing faster than the economy, just keeps widening the gap. The mechanics favor divergence. Hashtag, tag, tag, outro.
Well, we've covered a lot of ground. From Andrew Carnegie using force to control labor costs way back at Homestead, all the way to, Sam Bankman-Fried trying to manage the fallout from a massive capital implosion just recently. But there's this constant thread, isn't there? This mechanical, relentless pursuit and accumulation of extreme wealth.
Definitely. The methods change. Maybe it's industrial muscle. Maybe it's leveraging debt using the tax code. Maybe it's selling a tech vision. But the underlying result seems to be this persistent concentration. And it's always reinforced by using that wealth to shape the political and economic rules of the game.
The patterns feel consistent because those core mechanics, especially that tendency for capital returns to outpace economic growth, they seem pretty constant too.
Right. You have that force for convergence, knowledge spreading, skills improving, which is real and important. But it seems to be in this constant fight against the inherent divergence mechanism, where wealth just begets more wealth, often faster than the rest of the economy grows. Old wealth used factories and railroads. New wealth uses debt, data, maybe just pure narrative. But the structure seems tilted towards the top.
So maybe here's a final thought for you, our listeners, to chew on, thinking back to that history. We saw those Parisian rentiers, right? Immensely wealthy. But their whole way of life, based on passive capital, proved fragile when those huge external shocks hit. They ended up having to eat into their capital. Given how much of today's extreme wealth seems built on leverage, on complex finance, on maybe boundless optimism and constant growth. If the system faced another really big shock, political, economic, maybe technological, maybe environmental, or even if just the market sentiment, that enthusiasm, evaporated, is the lifestyle and the actual capital structure of today's super rich maybe more fragile than it looks, more vulnerable than their predecessors who owned land and factories? What kind of shock, realistically, could reset that capital to income ratio again? Something to think about.